The IRS collected over $6.5 billion in estimated tax penalties last year alone. And most of that money came from people exactly like you, freelancers who got paid, spent the money, and then faced a bill they couldn't handle. Your clients aren't withholding a single dollar for you. No employer, no payroll system. Just you, your bank account, and a tax bill that shows up like a punch in the face every April. In the next 10 minutes, I'm giving you the exact formula for how much to set aside from every single client payment so you never get blindsided again. Stay till the end, because I'll show you a savings trick that literally earns you money while you wait to pay the IRS. This channel exists for one reason: to make sure U.S. freelancers never lose money to the IRS out of ignorance. If that sounds like something you need, hit subscribe. Today we're covering exactly this: why the U.S. tax system is quietly working against you. The exact percentage to save from every payment is based on what you earn. The 2026 quarterly deadlines the IRS will not remind you about. The safe harbor rule, your legal shield against underpayment penalties. And the one bank account move that turns your tax savings into extra income. Something nobody explains when you go freelance: the American tax system was designed around employees. Every time a salaried worker gets paid, their employer automatically pulls out income tax, Social Security, and Medicare before the money even hits their account. The moment you become a freelancer, that entire system disappears. You are now the employee and the employer. That means the full 15.3% self-employment tax is entirely your responsibility on top of whatever income tax bracket you fall into. For 2025, that 15.3% applies to the first $176,100 of your net earnings. And it gets worse. A freelancer who owes $8,000 for the year but skips quarterly payments doesn't just owe $8,000 in April. They owe $8,000 plus IRS underpayment penalties plus interest. Every single quarter they missed. That's money completely wasted. So what's the actual number? How much of every client payment should you immediately set aside? The rule that works for most U.S. freelancers in 2025 and 2026 is to save between 25% and 30% of every payment you receive. This covers both your self-employment tax and your federal income tax combined. Where exactly do you fall? Earning under $40,000 a year freelancing, save 25%. Earning between $40,000 and $80,000, save 28%. Earning over $80,000, go to 30% or higher. Practical example. A client pays you $2,000 today. You're in the middle bracket. Transfer $560 into a separate account the moment that payment lands. Do not touch it. Do not rationalize spending it. That $560 is not your money. You're just the temporary custodian until the IRS collects it. Your actual take-home from that $2,000 payment? $1,440. Build your life around that number, not the full $2,000. Mistake number two that destroys freelancers financially is thinking taxes are an annual event. The IRS operates on a quarterly system. If you expect to owe $1,000 or more in taxes this year, which describes almost every active freelancer, you are legally required to make 4 estimated payments throughout the year. For the 2026 tax year, write these dates down right now. April 15th, 2026. June 16th, 2026. September 15th, 2026. January 15th, 2027. The IRS will not send you a reminder. No grace period notification. Miss the deadline and the penalty clock starts automatically. Not because you did anything wrong, but because the system is built this way. Calculating your quarterly payment doesn't have to be complicated. The simplest method that actually works every time a client pays you is to immediately move 25% to 30% into a separate savings account labeled tax savings. Touch nothing else. At each quarterly deadline, go to irs.gov/payments and pay whatever you've saved. That's the entire system. For more precision, download IRS Form 140ES. It has a built-in worksheet that calculates your exact quarterly payment based on your actual income and deductions. Now, the most important rule every smart freelancer uses. It's called the Safe Harbor Rule. This is your legal protection against underpayment penalties, even if your estimate is slightly off. If your adjusted gross income last year was under $150,000, pay at least 100% of what you owed last year, and the IRS legally cannot penalize you. But, and this is critical, if you earned over $150,000 last year, that number jumps to 110%. The IRS raises the bar for higher earners. Most finance videos completely miss this detail. The savings trick I promised, most freelancers have genuinely never thought about this. Most people keep their tax savings sitting in a regular checking account, earning zero interest. The disciplined ones do something different. They move that money into a high-yield savings account, an HYSA. Real math. Saving $500 per month for quarterly taxes means $1,500 sitting untouched between each payment. In a high-yield account currently earning 4% to 5% APY, that idle money generates $20 to $30 in free interest every single quarter. Over a full year, that's $80 to $120 earned simply by choosing the right type of savings account. Zero cost to set up. The IRS gets paid on time. You pocket the difference. The best current HYSA options are linked in the description. One action step from today, before this weekend's, open a separate savings account, name it Tax Savings, and commit to moving the right percentage every single time a client pays you. One habit. Permanent protection. Drop a comment below. What percentage have you actually been saving from client payments? Or have you not been saving at all? No judgment. I genuinely want to know where most of you are starting from. If this kept even one penalty out of your pocket, hit the like button. Subscribe to FinAction next week. I'm breaking down the 5 tax mistakes US freelancers make that can trigger an IRS audit. You'll want that one before you file. Every tax situation is different. For advice specific to your income and business structure, always consult a licensed CPA or tax professional. Take care of your money, and your money will take care of you.